Destroyed by debt. Is that going to be our fate? John Adams. There are two ways to conquer and enslave a country. One is by the sword. The other is by debt. Cicero. The budget should be balanced. The treasury should be refilled. Public debt should be reduced. The arrogance of officialdom should be tempered and controlled. And the assistance to foreign lands by the aid of our own resources should be curtailed. Benjamin Franklin. If you know how to spend less than you get, you've got the Philosopher's Stone. When you run in debt, you give another power over your liberty. Milton Friedman. The government's solution to a problem is usually as bad as the problem. Governments never learn. Only people learn. Even Churchill. I contend for a nation to try to tax itself into prosperity is like a man standing in a bucket trying to lift themselves up by the handle. And every new administration, not excluding ourselves, arrives in power with bright and benevolent ideas of using public money to do good. And when the money has been spent, they are surprised to find that the good has not been done. I wrote a piece back in 2012 entitled No Risk, and I want to get into it in a little bit. I saw a piece by a very prominent economist. Now, I go off on economists all the time, and I've been critical of this gentleman, Ken Rogoff, in the past. But he's done some pretty darn good work. His analysis of the Great Recession was good. But again, it was like a, how shall I put it? It was, coming in after the fact. Okay, it was, the after the fact coming in and analyzing everything that went on when, quite frankly, we knew what was going to happen. I think maybe Ken is growing. And listen, again, he's a very smart guy. You can take a look at his education and the Ivy League schools that he went to. He's Grand Master chess champion as well. Obviously, he's got a very high processor speed, very smart guy. One thing is missing. One thing is missing Ken Rogoff, like most economists out there. They've never done anything outside of being an economist. And to me, it's important that you've actually had to actually go out there and play the game, so to speak. Does that make sense? Again, I made this comparison before, like with the economists. It's like many of them got all their theories. They can read out everything and anything on the economy, all this good stuff. And again, it's like akin to reading every book written. Let's say you read every book written. Let's say Ted Williams wrote a book on hitting a baseball, and Mickey Mantle and Babe Ruth and everything, and you read them all and you studied them and you became a PhD in hitting a fastball and hitting a curve, but you never pick up a bat. Never pick up a bat. And that's pretty much across the board. And that's kind of the world we're living in nowadays. People that like to be experts in things. The same, that's what's ruining baseball as far as I'm concerned. The analytics department. Wait a second. I got a man on second and third right now. We're down by a run. No outs. I don't know. Maybe we don't try to hit the 3-run home run. Maybe we just try to get a run across, maybe bunt. Who knows? Anyway, throw that aside. Rogoff just put out a piece, and lengthy piece, echoing many of the sentiments that we've been trying to get across for some time here on the board. Some time. You can go back and read my pieces. Just one I just pulled up from June of 2012. He talks about how the United States has always been, we can borrow our way out of trouble again and again and again. We use debt better than anybody else, more vigorously than any other country in the entire world, whether it be our wars, whether it be our war on COVID, whether it be our war on poverty, war on drugs, recessions, whatever it may be. We borrow and borrow and borrow. I was actually being interviewed today, and I went off on a bit of a rant talking about how, our fiscal situation and how, quite frankly, when we want to have a war, we decide to go to war, we should be raising taxes. We should be raising taxes or selling war bonds. I remember the whole war on terror started with George W. Bush, and I was scratching my head at the time. He's basically telling everybody, hey, keep on living. Go out there, go shopping, keep living your lives, all this stuff. I said, whoa. You're going to start this big war here? And you don't think that maybe we should have a collective sacrifice of some sort as a nation? Pull everybody together? Well, everybody was together at that point in time. Yeah, that didn't last. Anyway, yeah, even Eisenhower raised, was he the last person to raise taxes because of a conflict? He raised taxes for the Korean War, if I'm not mistaken. Anyway, Rogoff goes on a rant here. He's the past few years have cast serious doubt on these assumptions that we can continue to borrow and spend. For starters, bond markets have become far less submissive, and long-term interest rates have risen sharply on 10 and 30-year Treasury bonds. For a big debtor like the United States, the gross U.S. debt is now nearly $37 trillion, roughly as large as that of all other major advanced economies combined. These higher rates can hurt. When the average rate paid rises by 1%, that translates to $370 billion more in annual interest payments that the government must make. We spent $850 billion on defense in 2024, more than any other country in the world, but we spent $880 billion on interest payments. Again, statements that we have made here on the program. We've talked about it here on the program. Talks about Trump and his efforts to place blame for the high rates on the Federal Reserve. Again, he's a little bit kinder in the way he states things. He says they're deeply misleading. I've said basically they're bullshit because they are. The Federal Reserve controls the overnight borrowing rate, but longer-term rates are set by vast global markets. The Fed sets the overnight rate too low, and the markets expect inflation to rise. Long-term rates will rise also. After all, unexpectedly high inflation is effectively a form of partial default. We've talked about this before here on the program. Since people are getting paid back, you're getting repaid in dollars that are worth less. The purchasing power has been debased. We're all dealing with that as a nation. If investors come to expect high inflation, they're going to naturally require a higher return to compensate. Now, the reason why there's a central bank, one of the reasons why to have a central bank is to say that inflation will be tamed. They're going to do what they can to keep that down and then allow for interest rates to stay down. If the Trump administration undermines Fed independence, borrowing costs are going to go up, period. The end. It is what it is. Skepticism about the safety of holding Treasury debt has led to related doubts about the U.S. dollar. For decades, the dollar's status as the global reserve currency has conferred lower interest rates on U.S. borrowing, reducing them by perhaps 0.5% to 1%. But with the United States taking on such extraordinary levels of debt, the dollar no longer looks unassailable, particularly amid other uncertainty about U.S. policy. In the near term, global central banks and foreign investors may decide to limit their total holdings of U.S. dollars. Over the medium and longer term, the dollar could lose market share to the Chinese yuan, and I don't think that that's so likely to happen anytime soon. The euro or even cryptocurrency. Either way, foreign demand for U.S. debt will shrink, putting further upward pressure on U.S. interest rates and making the math of digging out of the debt hole even more daunting. Now, again, this Steve Mirren fellow that scares the crap out of me that Donald Trump appointed. He's head of Donald Trump's economic advisors. He had this thing called the Mar-a-Lago Accord, where we could selectively default on our payments to the foreign central banks and treasuries that hold trillions of U.S. dollars. They talked about that. Now, I'm going to remind you, the President of the United States has had his experience with defaults and bankruptcies. I hope and pray that he recognizes that the United States is not a casino or a hotel in Atlantic City. With long-term interest rates up sharply, public debt nearing its post-World War II peak, foreign investors becoming more skittish, and politicians showing little appetite for reining in fresh borrowing, the possibility of a once-in-a-century U.S. debt crisis no longer seems far-fetched. Debt and financial crises tend to occur precisely when a country's fiscal situation is already precarious. Its interest rates are high, its political situation is paralyzed, and a shock catches policymakers on the back foot. Now, we already checked 3 of those boxes. All is missing is the shock. Even if the country avoids an outright debt crisis, a sharp erosion of confidence in its creditworthiness would have profound consequences, to say the least. And again, we can go back to spending, go back to Reagan and Reagan's, deficit spending. And again, dynamic should have changed after we bankrupted the Soviet Union. It didn't. Dick Cheney once said to George W. Bush, hey, Reagan proved deficits don't matter. Both parties do this, and it's patently absurd. Mind you, Biden ran a budget deficit of $1.8 trillion, 6.4% of GDP. Except for the financial crisis in the first year of the pandemic, that was a peacetime record. Again, beat his own 6.1% the year before. Again, Trump, big, beautiful bill. We're told that how wonderful it all is. But we've got 6 to 7% deficit, 6 to 7% for the rest of the decade. Again, we're told, we point this out, we're a bunch of panicans, right? We're panicking. We shouldn't think about this, and we're going to grow our way out of this situation. Okay. You want to rely on that? You want to count on that? I most certainly don't. Anyway, throughout most of modern history, Rogoff writes, it was thought that prudent government debt management involved bringing down the ratio of debt to GDP during quiescent periods of growth in order to basically store fiscal ammunition for the next crisis. Rainy day fund, right? In the 1800s, the United Kingdom used debt to fight one war after another, taking advantage of the time in between to repair its finances. Likewise, although the U.S. debt to GDP ratio was very high during World War II, it quickly declined in the years that followed. Since the United States had just fought 2 world wars, policymakers feared there might be yet another to pay for the Korean War. Oh, that's right. Eisenhower raised taxes instead of relying mainly on debt. Okay. Again, even though there was low interest rates, after the global financial crisis, this is when all of these wizard of smart economists out there, again, never done anything in their entire lives, never run a business, started coming up with ideas like modern monetary theory. And we can just keep borrowing and spending and borrowing and spending. You had Lawrence Summers write a paper and say that interest rates would stay low indefinitely because of factors such as adverse demographics and low productivity growth and chronically weak global demand. Paul Krugman, yeah, we love her. We love making fun of Paul here on the program. He basically said we could just keep printing and spending as much as we wanted to. In fact, he thought the bailouts for the Great Recession were too small. And again, it's embraced by politicians like Bernie Sanders and AOC. None of this matters. We can keep spending and keep handing out more money. I remember Nancy Pelosi talking about all of the handouts and giveaways and what a wonderful investment it was and how it was going to grow our economy. Right. The Great Repression. How and when a debt crisis in the United States couldn't fold is now the $37 trillion question. In one scenario, the trigger will be a collapse of confidence by investors in U.S. Treasuries. They call it a crack in the bond market, bond vigilantes. Jamie Dimon talked about this. Sudden spike in interest rates that again, we got a problem here. Debt crises, again, they build up steam quietly for what seems like forever before erupting. Investors' growing fears about the safety of their money could cause a gradual rise in Treasury bond yields over many months or years. Again, something like this most certainly would hit housing prices. It would most certainly hit stock prices as well. It would make doing business a hell of a lot more difficult. Again, we could print our way out of the situation. One of the things that we can do, keep printing, again, which is essentially is a default, because, again, you're paying back money, money you owe with money that's worth less. Actually, FDR did that when he messed around with the global peg to the dollar to gold back in the 1930s. Financial repression is another way. I've talked about this here on the program. It's where the government, pulls a Luca Brasi, starts calling up various different financial institutions, said you better be buying our paper right now. Again, that's what a lot of Europe did when they ran into the European debt crisis. Again, just force pension funds, force insurance companies, force banks to hold a hell of a lot more debt. I actually, blew the lid open on this one. Only person reported on this. Only one. Fact that the Treasury Department of the United States actually came up with an idea where they would summarily take over retirement accounts and basically say, hey, here's another retirement system that we're putting into place, basically taking over 401ks, all of these things, and basically saying that you had to own government debt in them. Yeah, there's actually Treasury papers on this. I'm not kidding. Another way, and I think they're thinking about this as well, is use cryptomania and have that dollar stable coins. Now, dollar stable coins, again, the legislation that was just passed by Congress basically says that U.S.-based dollar stable coins have to hold a mix of Treasury debt and federally guaranteed bank deposits. Again, they're thinking ahead. Again, this financial repression that they want to put into place. I'm going to go to my piece that I wrote back in 2012 to this, and was going after Tim Geithner at the period of time and the spending that was taking place. And, the fact, actually, it was funny. He was asked, Timmy Geithner, remember, was a Treasury Secretary at the time. And Paul Ryan asked Timmy Geithner why the Obama administration is not making any attempt to solve the long-term debt problem. And Geithner's response, you're right to say we're not coming before you today to say we have a definitive solution to that long-term problem. What we do know is we don't like yours. We was asked as well. He said, if we don't deal with these debt problems, we're going to be Greece in 2 years. Geithner responded, there's no risk of that. And one of the rules that we have here at the WatchDog on Wall Street is when somebody on Wall Street or some politician responds with no risk, there's plenty of risk. There's without a doubt, there's a lot of risk. Again, I'm looking at this piece I wrote then, and you look at the numbers from that point in time and how much worse they are today. And again, giving Timmy Geithner issues right now. It's not just Timmy Geithner. It's both parties. It's both elephants and donkeys, for crying out loud. And it's ugly. I mean, it really is. You take a look at what was done. You have to take a look at history. And, throughout history, how things, were handled. And, again, you want to print your way out of the situation, you end up with the Zimbabwe type of situation or a Venezuela type of situation. Again, this is throughout history. The Roman issued a gold coin called the orus. The face value of the original coin equated to the market value of gold in it. The Romans, much like the United States and other nations today, spent money haphazardly that they didn't have. Public subsidies, military expenditures, public works, and a huge government bureaucracy. The rulers of the Roman Empire raised taxes and minted more coins to pay their bills. Coins were issued with less gold, and over time, people lost faith in the currency. Chinese rulers started issuing paper money a little over 1,000 years ago. They, too, realized that they could buy a lot of stuff if they printed a lot of money, which is exactly what they did. Eventually, people caught on that the paper money had no value and prices rose. In order to keep up the scam, the rulers ordered death for people who would not accept it. Even nations with huge gold and silver reserves spent beyond their means. 16th century Spain was able to garner significant quantities of the metals from the New World. King Philip II managed to spend it all and then some. Sound familiar? Wars, shovel-ready palaces. He defaulted on his debt 4 times, even though revenue doubled during his reign. When 1576, when his revenue was up by more than 50%, his debt jumped by 1/3. His last bankruptcy occurred when peak gold shipments were coming to Spain. Again, there's constant examples of this. And this idea that this time it could be different is insane. We are still in a very, very good position as far as the world is concerned. I'm going to keep beating this drum here on the program in the hopes that maybe people will wake up to this and start voting accordingly. What I mean is, you have to stop voting for stuff. Have to stop voting for stuff we can't afford. You got to stop cheering on all the warmongers that want to constantly send money all over the globe. You got to start putting people into positions of power that actually want to deal with the problem. I'm prepared for it. My clients are prepared. Most people aren't. WatchDog on wallstreet.com.